Okay, wife and son own, no issues owning, wonderful. Wife and son own, wife and son own, wife and son own. I don't have any position of size to speak of at the moment, so half in, half out. All right. This is the UK. Not so good, so a bit worrying in terms of sales and profits and all the rest of it. I'll answer all those questions coming up, so don't worry, stick with it. Where are we on the the UK markets? And I'll do a separate webinar just focused on UK. I know Rolls-Royce has been doing incredibly well. You've doubled your money. P is only 29.7. Without having looked at all the financials on it, I would say I see no reason why it wouldn't continue, just as a sort of generic term. But I'd say my exit strategy, as I give my students, is if it drops X, sell Y. And guess what? That means that they're never wrong, because the definition of wrong would be taking on more risk than you wanted. And they're not doing that with that. Let me just get Rolls-Royce for you. Okay, Royce, R-O-Y-C-E. No, I'll have to find it later on the list. Right, well, ideally I want that going up a bit more like that rather than up here, because it could drop. So I might be able to pick it a bit cheaper. The worry is it'll go sideways for a bit. Longer term, it's going to do this, and that's fine. Really, the issue is the rate of growth. And remember, the exchange traded funds, the rates of growth aren't phenomenal necessarily. So if you look at this longer term, since 2019 to 2025, you've really only gone from about 36 to 53. You've not even doubled your money. Okay, over 5 years, you've not doubled your money. Now, over 5 years with equities, unlike exchange traded funds, you should be doubling your money, because that's just the 15% per annum, which is what you need to double your money over 5 years, which is the S&P. So that's just tailwind. That's background noise. That's background radiation. So you should be. ETFs tend not to be able to do it. They're just giving you less volatility and more stability. Okay, that's why you get ETFs: lower volatility, more stability, lower growth, of course. But with an equity portfolio, you'd expect at least to do that. And if you ramp it up to 25% average gain, let's say, because there's a tailwind, or you do better with an equity portfolio, then that would mean doubling it in 3 years. If you did double it in 3 years, count yourself lucky that you got a tailwind like 2023, 2024. And if you didn't, then that's the norm. Bit like houses in the 1980s in Britain. They used to double in 3 years if there was no recession, double in 5 if there was a recession. If you remember property, just look at property prices. Okay, that's what they used to do. No guarantee they'd continue doing it, or stocks. Apple, wife and son happily in. I think I'll just wait a little bit, because I think I might be able to either deploy my money elsewhere for a bit longer, because it might go sideways for a bit longer before inevitably going up. Okay, and if you want to argue that it's the end of Apple and it's shit and it's rubbish, then don't buy it. We don't need to have an argument over it. You know, it's not the Middle East crisis. We don't need to take a side, or Ukraine, Russia. You know, it's fine. Or Donald Trump and Democrats. We'll just say, oh, okay, you don't agree with me, fine, don't buy it then. Buy. Okay, it's a lot. You know, nothing ever to get flustered about. It's only money. That's its statistical projections of its moves based on its historic moves. So it's a bit like a coin. You know, a coin will 50-50. You know it's going to go within a certain range. So if you take a stock which isn't guaranteed in the future to go in a certain fixed range like a coin, but if you assumed it were to, which is a big assumption, then these are the future projections. And you can see that over a 250-day period, statistically highly probable to get a positive return. However, why do people mess it up? You mess up your pension for 2 reasons: panic and boredom. What is panic? Panic is when there's a low probability of a big move in a short period of time, i.e. this gets hit. That's when you panic, okay? And so that's where you never get to the gains. All of those people who sold Apple before today, basically, ever, right? They panicked, or they got bored, which means 250 days went by and then you got a 2% return. So either way, when you're on this left-hand side, that's what causes you to F up your pension. Boredom or panic. Boredom or panic. They're the only 2 things which ever cause you to mess up your pension or portfolio investment. Why do I show all this data? It has a very calming, soothing effect upon my students, who then realize, oh, I don't need to panic, okay, or be bored, right? That's why. 46% of you said you're pissed off with your fund manager because of underperformance. It should be even higher. Lack of communication, that's pretty bad. I mean, if they're not giving you webinars once a week for at least 1 hour, then yeah, that's lack of communication. Fees, I agree. You shouldn't be paying any fees, basically. You should be getting free webinars like I give you. Not trustworthy, damn right. Lack of information, education. They don't want you to be educated, because if you're educated, you'll know how stupid they are. Lack of transparency. I mean, look, listen, seriously, anybody can become an IFA. So if I said to you anybody could become a doctor, you'd say, no, I'm not going to trust doctors. I don't know why they have the same problem with IFAs. Microsoft, wife and son in, overbought. This is the typical classic problem at the moment. It is overbought. In other words, it's a bit like this. Imagine it was here. You'd probably say to me, well, I can see why, Alpesh, you're being a bit cautious. Let's say it was here and we didn't know what the future held, okay? Right? You'd probably say, if I said to you it was a bit overbought, i.e. it was here. So imagine we go back in time to here, as I've been saying anyway. You might say, oh, I can see why you're a bit cautious. And you don't want to dive in. Well, I'm still feeling exactly the same here as I was here. And let's assume this exact same scenario is about to repeat itself here. Okay? Now, does that mean, why did you throw your wife and son into it? Well, because there's enough probability it won't, and that'll happen. Well, why don't you go into it? Because there's enough probability it will happen. Got it? I don't know the future, but I know it's a good quality company and I'll be okay going forward. Because over 250 days, I'll probably use it with 2 times leverage on the ETF to try and get closer to a 20 to 40% return. Okay, and this is pre-leverage, so I'll be fine. Novo Nordisk, wife and son, yes. Me, not yet. Not yet, but oh boy, will I. Yes, in due course. Now, if you're risk-loving and you want to dive in, be my guest at your own risk. Me, I'd rather wait. Did I call the bottom? No, of course I didn't. But do I like it for the long term? Yeah, and this is what I mean by the nature of a quality company. Okay. Similarly with this, what I mean by the nature of a quality company is multiple years of significant gains. When the drops happen, they're predictable, as you can see here, and they're infrequent, and other drops are quite shallow and quickly recovered. Very few companies exhibit those characteristics. Those characteristics can be seen both statistically and visually, and they can also be seen in the P&L, balance sheet, and cash flow through this. Now, some of you are number autistic, and you'll see this, and you go, wow, I can see it on the numbers. Others are more visual, and you'll go, ooh, I get that. And some of you are mathematical, and you'll see it in this. I like to look at it in all three. Makes my life a lot easier.